An economic tempest is rapidly approaching, entirely indifferent to the imminent monetary policy transmissions of the Federal Reserve. While corporate entities nationwide execute aggressive cost reduction strategies, official employment metrics reflect mathematical fabrication. Systemic revisions recently revealed the non-existence of 800,000 previously reported macroeconomic positions. The contemporary domestic labor force is now saturated with multi-job participants, failing to sustain baseline liquidity relative to escalating cost of living metrics. Centralized interest rate adjustments, managed by the Federal Reserve, possess zero efficacy against these structural distortions. Official employment strength is an illusion, masking an affordability crisis driven by decades of engineered hyperliquidity. Public expectations for economic stability rely almost entirely on centralized interest rate adjustments. However, these mechanical rate changes lack the mathematical capacity to address foundational distortions in the labor and housing markets. Localized asset supply deficits, like a shortage of housing units, are a fraction of the problem. The data identifies a systemic affordability crisis that reaches across every sector of the domestic economy. For 20 years, near-zero rates cross-subsidized non-profitable enterprise structures and engineered artificial valuations. That operational window has ended, leaving the Fed with tools that cannot reach the underlying decay. We can measure this collapse by using 1970 as an economic baseline, a period of real wage equilibrium before the structural divergence began. This data table maps the historical wage-to-asset asymmetry, comparing median household income against median residential sale prices. Between 1970 and today, median household income grew from $9,000 to $80,000, an increase of approximately 8.8 times. In that same period, median residential sales escalated from $23,000 to $428,000, an 18.6 times increase. This divergence forced the income-to-asset ratio from a healthy 2.5 times to 5.3 times, a 112% escalation in the cost of assets relative to labor. This 112% gap mathematically disproves institutional claims that real wages have kept pace with inflation over the last 50 years. The modern $80,000 household income metric is a statistical mask hiding a shift in labor distribution. In 1970, female labor participation was 40%. Contemporary metrics show a near 100% expansion in this demographic. The modern household median income now requires twice the labor input to achieve, yet possesses less purchasing power than the single-income models of 1970. Systemic degradation has now compelled these dual income structures to produce less aggregate asset purchasing capability than the legacy single-income models. Collateral overhead acts as a secondary force crushing the remaining liquidity of the modern household. In 1970, childcare consumed 2% of gross household allocations. Current metrics demand 18%. This 18% overhead is mathematically equivalent to paying modern tertiary education tuition annually just to participate in the labor force. This lack of liquidity has driven unsecured consumer credit to exceed $1 trillion, even as annual percentage rates remain elevated. Families are liquidating their futures to survive, evidenced by exponential increases in 401k hardship distributions. The modern workforce is technically insolvent, funding structural decay through high-interest unsecured debt to maintain a baseline standard of living. The inflection point for this crisis occurred in 1971, with the unilateral termination of the Bretton Woods International Monetary Framework. By intentionally severing the fiat dollar from its underlying physical gold standard anchor, the government initiated an unrestricted monetary debasement. Eliminating specie convertibility allowed infinite supply expansion, degrading the purchasing power of every dollar in circulation. Elementary mechanics dictate that as the M2 money supply expands, the valuation of individual currency units mathematically degrades. Since 1913, the dollar has lost 97% of its value. Degradation is accelerating. 25% of that total destruction occurred entirely within the post-2020 fiscal window. The modern affordability crisis is not a byproduct of organic growth. It is the mathematical consequence of engineered currency debasement. Macroeconomic sovereign debt expansion is the primary engine driving the need for infinite liquidity. total sovereign debt has reached $35 trillion, compounding at a rate of $1 trillion every 100 days. Against this massive debt momentum, the Fed's 25 to 50 basis point rate optimizations possess zero capacity to divert the macro-structural collapse. The entity tasked with price stability actually drives liquidity distortion through the expansion of its own internal balance sheet. Rate cuts function as public relations to simulate control, but the structural deficit guarantees persistent inflationary momentum and eventual recessions. Fiat debasement functions as an unlegislated capital transfer, extracting wealth from the productive base to benefit institutional elites. Retaining capital within a structurally insolvent framework guarantees systematic wealth extraction. Protecting wealth requires exiting the fiat monetary infrastructure and moving into non-counterparty tangible assets, physical precious metals that cannot be diluted by political intervention. This is why sovereign central banks are executing de-dollarization protocols while aggressively accumulating physical gold reserves. Silver, like gold, represents finite, non-dilutable wealth that sits outside the engineered reach of the central bank. True wealth preservation requires recognizing this macroeconomic asymmetry and executing a decisive transition into physical specie.